AbbVie is a stock that I hold in my own portfolio, but is it looking overvalued now? Is it one we should be considering selling? We're going to find out in today's episode. We're going to run through, as always, taking a look at the historical performance. We'll look at their top line revenue as well as their bottom line net income growth. We're going to take a look at the health of this company, their total cash versus their total debt, and we'll see how well they're performing versus some in the industry as well as over the last 5 years. We'll talk about institutional ownership. We'll also look at insider selling that we have noted. And as always, we'll run through their dividend safety as well as looking at their financial metrics such as their free cash flow and their payouts. As always, we'll then run it through the valuation model. We want to get to our intrinsic value. We want to see what the acceptable buy price is, as well as seeing whether or not Wall Street forecasts any upside over the next 12 months. So let's start off. Let's take a look at the historical performance of this company. Now, it's been on a pretty solid run over the last year. It is up 8.5%, but just year to date, we are seeing double-digit performance, up 12.33%. Over the last 10 years, up 275%, so a fairly decent stock as we can see. Bear in mind this doesn't include those dividends reinvested, and we can see right now it is trading towards the upper end of the 52-week range. It offers a fairly nice starting forward yield of 3.5% and a forward PE sitting at just below 16. Now, in terms of looking at their top line revenue, 3 to 7% is what we target, 33.3 billion in December 2019. December 2023, their latest annual accounts showing 54 billion, so it has increased quite nicely. In fact, over the last 5 years, we would note though on a more granular level, we do see increases every year to 2022 before a slight drop. In terms of how that compares to their bottom line net income, well, we can see in fact the opposite. Whilst top line increased, bottom line decreased from around 8 billion of net income in 2019 down to 5 billion. So we can see it very inconsistent on a granular level. Some years increases followed by decreases. But we would say top line has increased, but unfortunately their bottom line isn't looking like it is moving in the right direction, at least on a consistent basis. In terms of the health of the company, total cash versus total debt, we see their cash dropped dramatically from 40 billion in 2019 down to their latest quarterly report of 12.8 billion. Now, that's not the worst case, but we do want to always compare how that has performed versus their total debt numerically and directionally. And what we can note is whilst their cash has dropped significantly, their total debt has also dropped from 67 billion to 61 billion, but not quite by the same amount of the cash. So something we'll look into, especially when we look at the net debt to EBITDA metric. Now, when we're comparing its performance, we're looking at others that are in the biotech industry. We have Amgen, Vertex, Regeneron, as well as a few others that we have all reviewed on the channel recently. Total return, so including those dividends reinvested, we can see AbbVie is in the middle of the performance over the last 12 months. When we extend that to the last 5 years, we can see AbbVie, in fact, one of the best performers, 164%. Only second, as we see here, to Moderna, up 351%. Now, do remember, though, past performance is not required or not something that is indicative of future performance. But again, past performance of AbbVie has been fairly decent. In terms of institutional ownership, well, 70.23%. We see 10.64 billion worth of sales by the institutions over the last 12 months. We see 2.5 times more buying by the institutions over the same period. And in fact, when we look at the more recent quarter at Q1, whilst we don't have the full data set available, we can see more buying than selling. And when we go back to the last 4 quarters in Q3, or in fact Q 2023, we see every single quarter more buying by the institutions than selling. So it is positive to note if you are an investor or potential investor. Now, interestingly, when we do look at insider ownership, 0.25%, we see quite a significant amount of insider selling of 73.21 million, with the largest coming in Q1 of 2024 of 68 million. When we take a look at these numbers, what we can see is the EVP, Nicholas D, on the 20th of March, did sell over 21,000 shares at just under 4 million, as we can see here. Also, Jeffrey R. Stewart, EVP as well, in March, also selling quite a significant amount more of just over 10 million. So a lot of selling in 2024, as we would note. Insider selling isn't necessarily a bearish signal. Now, you need to understand insider sell for many reasons, but it is something you can consider, and we do want to be transparent, show both buys and sells, so we can note that now on the screen. Now, before we look at the metrics, just to let you know, we have released our latest free weekly article. If you do want to gain access to this, as well as other articles on the channel, all completely free, instant access, do click on that pinned comment and sign up below. Now, in terms of their dividend safety score, we can see it is sitting at 80, so it does look to be safe. Market cap wise, 314 billion. It is a mega cap company. So in terms of the last recession, well, they didn't pay a dividend. However, they had plus 10% recessionary sales, which was above the average growth of the S&P, which came in at exactly negative 12. Dividend growth, while in October 4.7, not the greatest in all honesty. Yes, it is above that 4% we advocate on the channel to keep up in line with inflation. But given over the last 5 years and the last 10 years, we saw some very strong numbers. It was a bit of a disappointment. In terms of dividend growth, well, we can see whilst they were formed after the spin-off in 2013, they are classified as a dividend king with over 50 years of consecutive increases and, in fact, 100 years of paying a dividend without a reduction. Now, dividend yield theory, for those that are new, it states a company is undervalued when the current yield sits above the 5-year average. So we have here a double sign of overvaluation. The yield sits below 4.5, and also the forward P of 15.6 is above that 5-year average. But again, do bear in mind we don't look at any of this information in isolation and conclude towards the end. It is slightly lower than healthcare sector P as well at 16.6. In terms of the free cash flow for biotechs, below 50%, we see that near enough every single year, so no real worries in my opinion around dividend safety based on the payout. It is expected 54 in 2024, no real worries there. In terms of the free cash flow per share, and remember we do ignore earnings data, it is susceptible to manipulation by management through accounting. Free cash flow very healthy, increasing year on year for the majority of the last 10 years. 12.50 in 2023. It is expected to dip, however, so do note that in 2024. And when we look at the sales growth, whilst we do want to see that steady moderate 3 to 7%, as we mentioned in 2023, their top line was reduced, as we see here, by 6%. Nonetheless, the previous 9 years looking very solid, with the majority of this period showing double-digit growth to their top line. And we can see they've more than doubled their top line from 20 billion to 54.3 in 2023. In terms of shares outstanding, unfortunately, they would have diluted your position as a shareholder. They have increased those shares over the last 10 years, not by a massive amount, going from 1.61 billion to 1.77. In terms of the ROIC, looking fairly healthy. While we do want above 25% for biotechs, just to give us faith that management are able to effectively allocate their capital, we can see over the last 3 years it has been pretty much around that level, and over the last 10 years it straddles around that level, so we can see ROIC looking fairly healthy. No worries or anything to mention in terms of red flag indicators on both operating margin as well as the free cash flow margin, above the minimums that we do see for biotech consistently year on year. And in fact, the free cash flow margin has been increasing. 41-42% over the last 2 years is incredibly attractive for investors and potential investors to note. Now, finally, the net debt to EBITDA, essentially the earnings before the interest, tax, depreciation, amortization. We want below 1.5 for biotechs, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. And we note from the highs of 2020, it has come down. It is still above that 1.5 point. And remember, this does directly correlate to dividend safety as well as balance sheet strength. But it isn't massively above that, something we can factor into our margin of safety. But given their dividend or free cash flow payout isn't too high above that 50%, so far based on this information, I do believe that the dividend does look to be safe. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we are taking a look at today is the dividend discount model. Now, we can see the yearly dividends with their growth rates looking fairly healthy, although they have been decreasing. On average, 7.72% over the specified period. Now, forward looking, we have gone a lot lower, so this is more conservative and in fact in line with their more recent one at 4.75%. When we do take a look at that intrinsic value, we have our first signal here of undervaluation coming in at just under $200. But again, we're not looking at any of these one models in isolation. The next model, my favorite, the discounted cash flow model, we have the free cash flows year on year. Average growth rate very high at 31%, lower than analyst estimates with that 2% level, and we can see the discount rate at 8%. gives us the present value of these future free cash flows and terminal value. Add together with the cash, subtract total debt, we arrive at the equity value, divide by shares outstanding, and as we can see, another undervaluation signal. So the intrinsic value in today's episode is essentially the average of these two models, and this gives us an intrinsic value of today's episode of AbbVie of just over $200. Now the current price is $175, and a margin of safety is sitting at 10%. Remember, we do use that when we believe essentially the company meets the three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So if you believe that, a 10%, a buy up to $180. At 15%, we can see a buy up to 171. So it isn't quite there yet. So we see around 10 to 15% at the MOS level. In terms of Wall Street and their forecast over the next 12 months, well, they seem upside of 5%. They have a price target of $184. Now, this is one that I do hold in my portfolio. It has been on a very strong run just over the last year, or in fact, over the last few months, in fact. It is one that I have held for many years and is one that I can see myself selling if the price did get out of hand. However, based on the valuation that we have run through in today's episode, both of these models are coming in at similar price, around that $200. Given the price is at $175, we can see our intrinsic value calculated today is sitting higher. So this isn't a company that is trading above its intrinsic value. So I see no real reason right now to sell. If we suddenly saw the price get out of hand, go well above $200, it definitely would be one to consider. In terms of Wall Street and their forecast of over 5% or around 5% upside, personally, this isn't one that I would use for decision making. As I always do mention with Wall Street, they will revise their forecast on a very regular basis. If they see the share price of a company is going up, they will typically revise their price upwards. And the opposite does hold true. When companies are dropping in share price very rapidly, they will revise their price targets downwards. So for me, whilst we do always input the forecast of Wall Street on every episode, it should be taken with a pinch of salt and shouldn't really be made for any investment decisions. The one that I do typically look at is the intrinsic value to understand whether or not a company is trading around this intrinsic value. If it's lower and there is a nice margin of safety, it could be one to add to the portfolio. If it trades significantly above the intrinsic value, it could be one to think about either selling or just holding on to. So in conclusion, for AbbVie in today's episode, it does look very healthy. It is still below the intrinsic value. Regardless, Wall Street do only believe 5% upside, so this isn't one that they do believe is a strong buy now. As always, do let us know your thoughts in the comments below. Let us know whether you're adding, maybe you're selling, or this is on your watch list at a certain price. Don't forget you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment. And if you've enjoyed today's episode, smash that like button. We'll see you all on the next one, and for now, take care.